Hello, my name is Soham Chaudhary, and in today I'll provide my take on the HDFC and HDFC Bank merger.
In a historic move that sent ripples to the financial landscape, HDFC Limited and its subsidiary HDFC Bank have recently announced a merger that solidifies their position as one of the largest players in the Indian banking and housing finance sector. This merger, which came into effect from 1st of July 2023, marks an important milestone for both these entities and holds immense potential for investors and customers alike. With a total combined asset base of over 18 lakh crores, the new entity is set to unlock potential and value for the shareholders and stakeholders alike. The origins of this monumental merger can be traced back to the early years of India's economic liberalization. HDFC Limited, a housing finance company, was set up in 1977. Around 1990s, after India's economic liberalization, there was a huge surge in demand for loans, both from businesses and individuals alike, as borrowings was increasingly being embraced. Understanding this immense potential, HDFC Bank was founded in 1994 and commenced operation from Jan 1995. Over time, HDFC Bank and HDFC Limited both gained reputation in their respective field. HDFC Limited as a housing finance company and HDFC Bank in the banking industry, while gaining a reputation for a cautious lending approach. For years, there were advantages in maintaining two separate institutions. Banks, on one hand, had access to cheap deposits, but paid for that privilege with onerous capital requirements, strict and stringent rules and regulations. For example, banks had to devote a percentage of the credit to priority sector. NBFCs, on the other hand, were easier to create, had less stringent capital requirements, and less strict rules and regulations. But they had no access to cheap deposits that banks had. As a result, lot of NBFCs sprang up in a very short period of time. As a result, many NBFCs went on a lending and borrowing spree. During the 2018-19 period, several prominent NBFCs, including ILFS, collapsed. There were fears of many more such failures to come, and funding dried up for such finance companies. All of this resulted in a credit crunch. Since then, RBI has tightened regulations applicable to NBFCs. The complex capital requirements imposed on them have been increased to bring them in parity with the banks. That has made the operating limitations of finance companies somewhat similar to banks, but without the benefit of cheap deposits. As a result, we can say that it makes much more sense for the housing finance giant to merge with its banking arm. NBFCs have a problem. As they grow larger and larger, the need for cheap deposits keep growing. That is the reason why big NBFCs usually see their profitability and return ratios drop after a certain point of time. NBFCs, since they don't have access to savings and current account deposits, have to raise capital from the market at a higher rate, especially when compared to banks which do have access to such cheap deposits. This is the prime reason why HDFC Limited was valued so less when compared to other entities. After the merger, the combined entity will have access to cheap deposits and will be able to handle this sector much better. In the early 90s, the mortgage penetration in India was about 1%. Today, it's around 10.5%. That might seem impressive, but when compared to Western countries, which have a mortgage penetration of around 40 to 50%, Even China has a mortgage penetration of around 20% of its GDP. This shows the immense potential that still exists in this sector. Home loans are usually adhesive assets. That is, when a customer takes a home loan, they usually stick with that bank for around 15 to 20 years, which is a very big important thing for companies. Despite this, HDFC Bank's performance in this sector has been quite poor. It has been steadily losing its market share to other banks such as ICICI Bank and Kotak Mahindra, and other housing finance companies such as LIC and L&T Housing. After the merger, HDFC Bank will be at a much better place to deal with such competition. This merger will specifically bolster HDFC Bank's position in the home loan sector. With HDFC Limited's expertise in the mortgage business, HDFC Bank will be able to offer variety of home loan products to its customers. Currently, HDFC Bank's exposure to this sector is around 11%, but after the merger, it will come out to be around 33%. This will provide strength to HDFC Bank to stave off competition in the home loan sector. The successful completion of this merger is likely to set a precedent and trigger a series of similar deals within Indian banking sector. Competitors may seek the route of acquisition or merger to close the gap with HDFC Bank and also to harness the benefits of consolidated operation, increased market share, and economies of scale. The merger of HDFC Bank and HDFC Limited is a pivotal moment in India's financial landscape. The strategic alliance brings together a leading private sector bank and a premier housing finance company together and creates a financial behemoth with a huge customer base, extended reach, and diversified product offerings. The impact of this merger extends beyond just the balance sheets of these two companies, offering a renewed impetus to the Indian economy, driving growth, and fueling innovation in the financial sector.